best in radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
And welcome. You're listening to the Financial Survival Network. It's Kerry Lutz, back from a brief trip. We were off on Thursday and Friday, brief trip to the Keys to recharge our batteries, and time well spent. But now we're with John Rubino, dollarcollapse.com, co-author of The Money Bubble. And the money is bubbling now, John, isn't it?
It is, Kerry. Another eventful week for us to cover.
Yes.
What happened in the last week is that we ended QE, probably temporarily, but for now, we claim to have ended it. And in anticipation of the global financial system, especially the U.S. markets, freaking out, as they have done in the past every time the Fed tries to end a quantitative easing program, the whole rest of the world jumped in to help us. You know, the European Central Bank announced that it was going to begin its own big QE program, which was probably open-ended and potentially huge, and they're going to buy back asset-backed bonds across the Eurozone. And that caused interest rates to go back down in Euro. They were starting to spike in the peripheral countries, and this kind of calmed that market down. And at the same time, Japan announced that their version of social security system is going to massively increase its equity purchases. In other words, they're going to shift out of bonds and into stocks, mostly Japanese stocks, but also stocks from other countries. And the Japanese central bank announced that they were going to dramatically ramp up their own QE program. You know, they're now buying all the bonds that are issued by the Japanese government. So they're basically just monetizing 100% of the government's new debt. Now, combined, all of these things made or more than offset the cessation of QE in the U.S. and sent the financial markets through the roof. All the world's equity markets went up, and bonds were well behaved, and everything looked awesome, except for one thing: the dollar went through the roof versus the euro and the yen, which means that we are now in effect importing the deflation of the rest of the world, because a strong currency is basically the same thing as higher interest rates. It makes debts harder to manage and makes inflation lower than it would be otherwise, you know, because it pushes down the price of imports, which is deflationary. So we're now setting the stage for even lower inflation in the U.S. when inflation is already below the Fed's 2% target, at least according to reported numbers, and a harder time for our exporters because a 10% higher dollar, which is basically what has happened so far this year, makes exports from the U.S. to the rest of the world 10% more expensive and therefore harder to sell. And so basically what we're doing is kind of taking a bullet for the rest of the world here. You know, Japan and Europe were in danger of dropping into deflationary spirals that could have metastasized and just taken down the whole world into a 1930s style collapse. And they're still in danger of that because, the past QE programs that they tried haven't worked. But temporarily, we've stopped the bleeding by allowing the dollar to go up relative to their currencies. In other words, the euro and the yen are way down, which helps their exporters and presumably gives them a little breathing room. But that breathing room comes at the expense of the U.S. So 2015 is going to be an interesting year because we're going to see surprisingly slow growth and maybe a tip back into recession if the dollar stays this strong. And if the dollar doesn't stay this strong, if it falls back down, then that's the same thing as saying that the euro and the yen go up again, which will send Europe and Japan right back into those deflationary spirals that they were in 2 weeks ago. So there's no way out of this, but it's just an interesting set of moves and counter moves that we've seen in this last week that presumably set the stage for something dramatic in the year ahead.
So if I might paraphrase you, then we're actually not living in the best of all possible worlds anymore, are we?
Well, if you own a big bond portfolio or a stock portfolio, it is the best of all possible worlds right now, but your future is dark, and so 2015 will be a time when some of these chickens come home to roost, because we're already feeling the effects of a stronger dollar in the U.S. right now, and if corporate earnings come in below expectations, or the real estate market starts to crack, which U.S. housing is already cracking. The number of purchase mortgage applications, in other words, people taking out mortgages to buy houses, is at a 19-year low. That's not a recovery number. That's a crash and burn kind of number for the real estate market. And homes, individual real estate is a very big deal to the U.S. because that's the biggest asset that most people own. So if home sales fall and that pulls prices back down, that's a really serious issue for the U.S. economy, and we're headed that way. So as good as things feel right now in the financial markets, they could feel that bad when all of this stuff comes to light. And it's starting to feel like we're not far from that. The stock market has been on a tear, and it's at levels that normally precede big crashes. In 2000 and in 2007, the equity markets look like this in terms of PE ratios and the amount of margin debt that people had taken on to buy more stocks by borrowing against their existing stock portfolios. Stuff like that. Today is just like it was in 2007 and 2000. In some ways, it's more extreme. So based on history, we're headed for something serious again. And the rising dollar could be the catalyst, because that makes everything harder at a time when we can't really tolerate hard stuff, because we're priced for perfection. If it's anything less than perfection, you need to sell your stocks. And that's the thought process that will be dominating the financial markets going forward, with one big caveat, and that is that for the first time in history, the world's central banks are actively buying stocks. That's never happened before on any kind of scale. We had the plunge protection team in the U.S., and presumably the rest of the world had their variations on that theme, where in times of crisis, the government would come in and buy futures contracts or major blue chip stocks or whatever, and try to support the market. Yeah. It was, you get in, you stop the bleeding, you get back out. Well, now it's a long-term proposition of policy of governments intervening in the equity markets by buying futures contracts again, or ETFs now, or directly buying stocks. And that's a wild card, because these governments are not looking at valuation. They're not saying, oh, McDonald's is trading at a 17% or 17 PE ratio, and that looks pretty good to me. I'm going to buy some McDonald's. No, what they're doing is just buying across the board. And so they're pushing up prices indiscriminately, which is yet another distortion in the pricing mechanism that used to be the thing that guided capitalism. You look at the price of something, and that tells you whether to build a factory to make more of it, or to sell your stockpile because it's too expensive, whatever. Now there's nothing like that out there. You can't look at prices and derive preferred actions from those prices, because you got governments in there just manipulating everything in sight for their own political aims. And this is the big one. And manipulating interest rates is something that at least has been done in the past. We're doing it on a bigger scale than ever now with the bond buying on the part of central banks. But manipulating stock prices is new and orders of magnitude more dangerous. So that's the big wild card in the year ahead. If you were just looking at fundamentals, what I said earlier about, we've got a really turbulent year ahead in the stock market, and a major crack in the major stock indexes probably would be true. And because stocks are being bought so aggressively by governments, that changes the nature of that prediction from 99% true to 50 or 60 or 70%. It'll probably still happen, but you've got governments in there doing things that make it harder to predict, because they basically have unlimited printing presses. They can buy as many equities as they want to, just like they've done with bonds in the past decade. And if they really get going, who knows how high equity prices could go? We could see the mother of all stock bubbles, something that exceeds the year 2000 level of tech stocks. That would be horrible. That would set the stage for a crisis, the likes of which we've never seen before. But it's definitely a possibility now that governments have totally gone off the deep end and they're buying equities. My guess is that we'll at least have one more scare before they really try the all out, let's buy all the stocks in the U.S. stock market or whatever they're going to end up doing. And that scare is coming in 2015, and it's going to stem from the dollar getting too strong and causing trouble here in the U.S. So, we'll see how it plays out. But I think that's highly likely going forward.
It's just crazy. Whatever happened to limited government and letting the free market work its wonders? I guess nobody in power believes in any of that now, or they're too frightened of the results if they let government, if they let the markets work their magic. Is that what it is?
Well, it's a case of mission creep. They started out setting short-term interest rates and trying to manipulate the markets in that way. And then they went on to long-term interest rates because short-term interest rates had already been taken to their logical extreme. They'd been pushed down to zero. So they went on to push long-term interest rates down to record low levels. And then that kind of got used up. There was no way to manipulate bond yields down much below zero. A few countries have gone to negative interest rates, but that's, even to the guys running those governments, that's a bizarre, dangerous, alien kind of public policy. So now they've moved on to equities. And so, I don't know where they go next. I don't know if there's anything left to do in terms of these kinds of market manipulations beyond capital controls and stuff like that. When it doesn't work, when buying equities doesn't work and all the smart money just decides to sell their money or sell their stocks to the government, and governments end up accumulating the majority of the equities of the world, and therefore, being unable to really manipulate the economy through stock prices because nobody's paying attention anymore. The next final thing to do is capital controls, where you just decide what people are going to do with their money. They can't take it out of the country. The 401ks and IRAs just get converted into government bonds, and it goes on and on. That's the nightmare scenario of government overreach, and that looks like it's going to come. I mean, these guys seem to feel like they have no limits. When they're buying up literally trillions of dollars worth of equities. That kind of implies that they feel omnipotent or incredibly desperate, depending on the personality type of the guy in charge of whatever institution we're talking about. And so really crazy stuff. This is pretty crazy, but really crazy stuff would not be that big of a logical leap for them. So, yeah, I don't know, Kerry. The world looks scarier and scarier as these policies get put into place, are found not to work, and then are taken to even more extreme levels. And that's really where we are now. I mean, I can't stress how crazy governments buying equities on vast scales is. That's just something that if you're trying to run a capitalist economy, should never happen, because it completely destroys the mechanism that makes capitalism work. You can't allocate resources effectively if the pricing mechanism of the markets is impaired.
There's no recognition of risk. There's no allocation of risk.
Yeah. Well, I mean, you can't figure. Yeah, you can't figure out what your risk is or what your reward is going to be. You just can't figure it out. And so, you've got all this money. Interest rates are very low, so you just roll the dice. Because you figure, well, I've got maybe 5 more years running this company. Let me build an empire. And then if it blows up, I bet I can keep it going for 5 years. Then I'll leave, and my successor will be stuck with the mess, but I'll be rich. And in the meantime, I'll get to build an empire. That's the level of the analysis that happens when there's no pricing mechanism out there to show you whether you're doing the right thing or wrong thing.
There's some guys at a company, big company, I think you might have heard of them, did exactly the same thing, and it really didn't work out for them. You probably heard of the company. It was called AIG.
Yeah, AIG.
Yeah, remember them?
The government was basically encouraging the financial system to take on more and more risk. AIG was an insurance company, which is typically the most conservative part of the financial ecosystem. And they became basically the biggest derivatives player in the world. And it blew up. It would have not just bankrupted them, but just evaporated them. You know, they would have just ceased to exist except for buildings and a few people, you know. And they would have taken down Goldman Sachs and JP Morgan Chase and Citigroup with them, except that the government came in and bailed them out to the tune of trillions and trillions of dollars. We still don't know how many trillions of dollars got thrown at all these institutions that would have ceased to exist and really should have ceased to exist. You know, you need major bankruptcies in capitalism as an object lesson, because it shows everybody else what not to do. And when you short circuit that process and you say, well, nobody can go bankrupt now because they're all systemically important, they're too big to fail, then all of a sudden you lose that object lesson and you create a separate, different, opposite object lesson, which is that do anything you want to, you know, in the short run. Just go for the fee income and the prop trading desk income right now. And if it doesn't work out, the government will take care of you. And so that's called the Greenspan put now. And it was put into place in the late 1990s and has continued throughout the subsequent 20 or so years. And it's only gotten bigger. You know, these big financial institutions know now, not just hope. They know that if they get into trouble, they'll get bailed out. And so their incentive is to generate as much fee income and as many capital gains as possible in the short run. Let that flow into net income and earnings per share, generate huge year-end bonuses for everybody who makes these decisions, and then let the chips fall where they may eventually. Because these guys are banking their bonuses. They're not going to do clawbacks where they come in and take away the bonuses of the guys running IBM or Apple or whoever right now. That money is theirs forever, and they know it. And so, you know, if Goldman Sachs goes bankrupt, the guys running Goldman Sachs will still walk away with their bonuses for the last 10 years. They will still be rich. They can go off to an island or whatever and lick their wounds on their yacht. And to them, that's not a bad prospect. You know, all things considered, is a worst case scenario. And so that's what the financial markets are doing now. That's how they're operating. It's become a huge casino. And corporations now, non-financial corporations, have joined the party by borrowing huge amounts of money in order to buy back their stock. So these stock buybacks funded with cheap corporate debt are pushing up share prices, which are the main determinant of CEO income. And they're doing it with more and more borrowed money, so their balance sheets are getting more and more out of whack, more and more leveraged. And when it blows up, these really high leverage corporations, these big companies that look solid right now but have so much debt on their books will get into trouble. You know, some of them will go bankrupt, some of them will just plunge in value, and the guys in charge now will be gone by then.
Yeah, but the important thing is that Tim Cook is gay. Right?
Yeah.
Forget about the stock buybacks.
I couldn't care less about Tim Cook's sexual preferences, but his financial preferences are a little scary. You know, Apple is borrowing huge amounts of money when they already have a ton of cash. You know, they have close to $200 billion of cash, and yet they're still borrowing huge amounts of money in the U.S. in order to buy back their stock, so they don't have to repatriate their foreign cash and pay taxes on it, and so their balance sheet is deteriorating. But of course, Apple isn't really such a good example of that, because they have one of the handful of products in the world that everybody wants to own. Yeah. And so they'll probably be okay, even though the things they're doing are definitely questionable from a financial standpoint. But there are a lot of other companies that don't have iPhones to sell. And yet they're still borrowing huge amounts of money to buy back their stock. And they're going to pay a price for that at some point.
Yeah. What Apple's doing is financially unsound. It's just that it's such a sound company because the sales keep coming in that it doesn't matter. But it's a bad example. You know, if they're a role model for corporate America, they're a lousy role model.
Yeah. And they really are a role model because they're this brilliant company. You know, Apple, Google, a handful of others are the companies that everyone looks to as examples of absolute brilliance translated into a huge bottom line. They make huge profits by creating products that are absolutely dominant in their niches. And so, as such, they are admirable. But again, it's the lesser companies that are following their financial examples that might be. And I don't know about Google. I really haven't paid attention to how much money they're borrowing in order to buy back their stock. But you see IBM, for instance, as one example of a company that's seeing lower sales year after year. They are not growing, and yet they're borrowing huge amounts of money to buy back their stock in order to support their stock price and their executive compensation. And that's incredibly dangerous. And it's something that runs out of steam at some point. That strategy has a logical conclusion, which is eventual bankruptcy if you keep doing it. And you keep going for a certain point.
And they just announced last week they're buying back, after that disastrous quarter, they're buying back $5 billion more in stock.
Yeah.
To paper over it for that much longer. And to what end? It's really nuts. And where's it going to end is the question. And I guess it's not where it's going to end; it's when it's going to end, right?
Yeah, this has an end point, but we don't know when it is.
Yeah, but it's not going to be pretty.
Yeah.
So on that note, find John's work at dollarcollapse.com. Check out his book, The Money Bubble. Read it. Excellent reading. He wrote it with James Turk of goldmoney.com. And, we'll have to do a webinar one of these days, John, because, what's happening with the price of gold, you've seen it drop. It's below 1,200 now. If we check out our Kitco board here, it's around $1,169. Silver's down below $17. It's down to $16.09 as we speak. And even oil, $80 the barrel. So we got some deflation going. The question is, are we going to see a repeat of 2008, 2009? Is that what's really taking place behind the scenes? But this time it's going to take place in Europe and Japan, not in the U.S., because I think the banks here have been pumped with enough liquidity to ride out the storm. I don't know, but something is definitely happening, John.
Yeah, something is definitely happening.
So hey,
interesting year ahead.
Yeah, you need to be reading those articles on financialsurvivalnetwork.com. We got them coming from all over the world, thanks to our webmaster, Stefan. And certainly you're not going to see it on CNBC or the mainstream media. Sign up for the newsletter. John, talk to you next week.
All right, Kerry. See ya.
FSN Radio. It's all about what's next.
People have been using gold and silver to protect their wealth for thousands of years. Shouldn't you? That's why I go to Cloud Hard Assets. Tom Cloud has been in the business for 38 years. Call him now at 800-247-2812. Tom's service is outstanding, and you can buy with complete confidence. Order today, and you'll have your metal in your hands in 10 days or less. Tom takes the guesswork out of what to buy, and you'll buy at the lowest possible prices. And as a special to FSN listeners, you'll get free shipping and insurance. So call Tom today at 800-247-2812. That's 800-247-2812, or find him on the web at cloudhardassets.com and tell him Kerry sent you.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.